A guy walks into a car dealership with $10,000. The car costs $10,000. Perfect match. But here's the thing. The dealer knows the guy has $10,000. So does every other buyer. So the dealer raises the price to $12,000. Now nobody can afford it. So the government steps in and gives everyone an extra $2,000 to help with affordability. Generous, right? Except now everyone has $12,000. So the dealer raises the price to $14,000. The government gives everyone $2,000 more. The dealer raises it again. This cycle continues until the car costs $30,000 and everyone's drowning in debt. And somehow we're calling this an affordability initiative. Welcome to 2026, where every policy designed to help you buy things is actually making those things more expensive. And the worst part is, this isn't an accident. Here's what I'm going to show you. The United States government is trapped in a debt spiral that requires inflation to function. Every policy marketed as helping affordability is actually stimulating demand without increasing supply, which is economic speak for making prices go up. And the $36 trillion debt sitting on the books means they can't stop doing this, even if they wanted to. By the end of this, you'll understand why your grocery bill keeps climbing even though the economy is supposedly fine, why housing is less affordable despite lower mortgage rates, and why the government is quietly rooting for the very inflation they claim to be fighting. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Let me give you the central metaphor that explains everything happening right now. Imagine an auction house with 100 people and 10 houses. The auctioneer knows most people can afford about $300,000. So the bidding settles around that price. Now imagine the auctioneer's boss, who happens to owe a massive debt to the auction house owner, comes up with a plan. He starts handing out cash to every bidder. $20,000 here, $30,000 there. Suddenly everyone can bid higher. The houses still sell to 10 people, but now the prices are $350,000 instead of $300,000. The people who won the houses aren't actually better off. They just paid more. But here's the critical part. The auctioneer's boss needed this to happen because he gets paid a percentage of the total sales volume, and he needs that money to pay down his debt. He's not trying to help the bidders. He's trying to inflate the transaction volume to skim more off the top. This is US fiscal policy in 2026. Let's start with housing because it's the clearest example of this in action. In January 2026, the Trump administration announced 3 major policies. First, they authorized 401k withdrawals for home down payments. Second, they directed Fannie Mae and Freddie Mac to purchase $200 billion in mortgage bonds to push rates down. Third, they proposed banning institutional investors from the single-family home market. On paper, these look like affordability measures. Cheaper borrowing, more cash for down payments, less competition from BlackRock. But look at what actually happened. Mortgage rates dropped to 6.06%, the lowest in 3.5 years. That's real. Goldman Sachs calculated it as a 15 basis point reduction. But in that same period, the average down payment required increased from $15,000 in 2019 to $32,000 in 2026, more than doubled. And housing inventory hit a 40-year low while new construction stayed below replacement rate. Here's why this happened, and it's pure supply and demand. When you make borrowing cheaper, you increase how much people can afford to pay per month. A family that could afford a $2,000 monthly payment at 7.5% rates can now afford a bigger loan at 6% rates for that same monthly payment. So they bid higher. Everyone bids higher. But here's the problem. You can cut interest rates with a Federal Reserve meeting. It takes 1 afternoon. Building a house takes 2 to 3 years from permit to completion. You've got zoning fights, construction labor shortages, material costs, NIMBY lawsuits. The supply response is geologically slow compared to the demand response. So what happens? Instant demand increase, multi-year supply lag, and prices rise to absorb the extra purchasing power. There's a case study that maps perfectly onto this. 1971 to 72, Arthur Burns was Fed chairman. Nixon wanted to win re-election in 72, so he pressured Burns to cut rates. Burns complied. Mortgage rates dropped about 50 basis points, similar magnitude to today. Housing demand surged. Nixon won re-election in a landslide. And then inflation went from 3.3% in 72 to 13.5% by 1980. It took Paul Volcker jacking rates above 15% and causing a brutal recession to finally break it. Studies by economic historians identify the core mistake as stimulating demand when the economy was already near capacity without corresponding supply expansion. You can't make people richer by printing money if you're not producing more stuff. Now let's talk about the 401k withdrawal provision, because the math here is devastating. Say you're 35 years old and you pull $50,000 from your retirement account to make a down payment. Seems reasonable, right? You're using your money to buy an asset. But here's what you're actually doing. That $50,000 invested in a standard index fund at 7% annual returns over 30 years until you're 65 becomes $380,000. You just traded $380,000 in future retirement security for the privilege of overpaying for a house in an inflated market. The National Bureau of Economic Research has studied this pattern extensively. Early retirement account withdrawals correlate with significant reductions in retirement security, especially for people who are going to receive below replacement Social Security benefits, which is everyone under 45 right now. But here's where it gets really interesting. Let's run the actual numbers on affordability. A $400,000 home at 7.5% interest gives you a monthly payment of $2,796. A $450,000 home at 6.06% gives you a monthly payment of $2,723. You're paying basically the same monthly amount, but the house costs $50,000 more. The rate reduction didn't improve your affordability. It just let you pay more for the same roof. And in markets with the most constrained supply, San Francisco, New York, Boston, the price increases were even larger. All the benefit of cheaper credit went to sellers, not buyers. This is what economists mean when they talk about inelastic supply. When supply can't expand quickly, demand increases just bid up prices. Now you might think, okay, housing is screwed, but at least other sectors are different. Let me tell you about energy, because this is where the story gets even weirder. 2025 policy included lifting restrictions on federal land drilling, expediting fossil fuel project approvals, resuming LNG export authorizations, halting 5 Atlantic offshore wind projects, and extending permits for aging coal plants. The production data looked great. U.S. crude oil hit 13.2 million barrels per day in January 2026, highest in American history. Natural gas production also at historic highs. More supply should mean lower prices, right? Economics 101. Except residential electricity costs increased by 6.7% in 2025. Natural gas heating up 9%. Some regions got hammered. Washington, D.C. saw a 23% increase. Indiana, 17%. So what happened? Why didn't record production lead to lower prices? The answer is data centers. Data center electricity consumption doubled from 4% of US total in 2023 to a projected 8% by 2027. AI model training requires over 1,000 megawatt hours per large language model. Crypto mining adds another 25 terawatt hours annually. All of this new demand is clustered in Virginia, Texas, and Oregon, exactly where electricity costs spiked hardest. Here's a supply lag problem again. Average construction time for a natural gas plant is 3 to 4 years. Nuclear reactor, 7 to 10 years. Offshore wind farm, 5 to 7 years. Even restarting a retired coal plant takes 12 to 18 months. And most can't be economically restarted anyway. Net generation capacity from 2024 to 2025 was basically flat. We retired 15 gigawatts of capacity. We added 17 gigawatts. But demand growth needed the equivalent of 12 gigawatts annually. We're adding capacity at barely replacement rate while demand is accelerating. And then there's the export market dynamic. When you authorize more LNG exports, you're integrating the US natural gas market with global markets. Suddenly, consumers in Kansas are competing with consumers in Germany and Japan. US natural gas prices increased from $3.20 per million BTU in 2023 to $4.80 in 2026. European prices are around $6.50. Asian spot prices are $12 to $14. We're exporting natural gas that used to stay in the domestic market. This is economically efficient from a producer's perspective. They maximize returns by selling to the highest bidder globally. But it raises domestic retail prices because we're now competing in a global auction. There's a historical parallel here too. 1973 to 74 energy crisis. OPEC imposed an embargo after the Yom Kippur War. U.S. petroleum production was already declining from its 1970 peak. Domestic demand was outpacing domestic supply. The government imposed price controls, which created artificial shortages. Gas stations ran out of fuel. Prices quadrupled when controls lifted. Consumer inflation hit 12%. The economy fell into recession. The lesson from that era, which economists have studied exhaustively, is that price shocks are most severe when supply capacity is tight and inflexible. When the system has no spare capacity, any demand increase or supply disruption causes dramatic price spikes. We're running the same experiment again. Here's the kicker on those canceled wind projects. The 5 Atlantic offshore wind farms that got halted represented combined capacity of about 5 gigawatts. That's enough electricity for roughly 2 million homes. They would have been operational between 2027 and 2029, exactly when projections show the grid getting increasingly strained. The levelized cost comparison shows offshore wind at $89 per megawatt hour, natural gas at $68, existing coal at $42. Short-term economics favor fossil fuels, but long-term capacity requirements favor diversification. You need multiple sources to ensure you can actually meet demand. Summer 2025 saw 34 grid stress events compared to 18 in 2023. 7 states had to implement demand reduction protocols, basically begging consumers to turn off their air conditioning so the grid wouldn't collapse. Let me tell you a story about a family in Indianapolis. Household income, $52,000 per year. 2 kids. Their electricity bill in 2024 averaged $135 per month. By December 2025, it was $162. That's an extra $324 per year, which doesn't sound like much until you realize that's equivalent to about 1.5 weeks of groceries for that family. Their natural gas heating bill went from $90 monthly average to $118. Combined, they're spending an extra $600 per year on energy, which is roughly 2% of their gross income. These are non-discretionary expenses. You can't just stop heating your house or using electricity. And this is happening while politicians are claiming they're helping with affordability. Now let's talk about the debt trap, because this is where the incentives become absolutely clear. The US federal debt is $36 trillion as of early 2026. The debt to GDP ratio is 122%. That means government debt equals 122% of everything the economy produces in a year. The only other time we've been close to this was post-World War II in 1946, when it hit 106%. But there's a critical difference. After World War II, we had expanding working age population, strong productivity growth, and decades of fiscal restraint. Deficits averaged 0.2% of GDP from 1946 to 1970. We had the economic capacity to grow our way out of the debt. 2026 is different. Aging population, slower productivity growth, and the federal deficit is $1.9 trillion this year alone. We're spending $1.9 trillion more than we collect. The Congressional Budget Office projects this gets worse. By 2034, debt to GDP hits 166% under baseline assumptions. With the tax cuts fully phased in from the Working Families Tax Cut Act, the Committee for a Responsible Federal Budget estimates potentially 185%. We are accelerating toward a fiscal cliff. Now, here's where the psychology gets interesting. A government facing high debt to GDP ratios has 3 theoretical options. Option 1, raise taxes. Politically brutal. Voters punish politicians who raise taxes. Option 2, cut spending. Economically painful. Every program has a constituency that will fight you. Option 3, allow moderate inflation. This is the quiet option. Here's how it works mathematically. Nominal debt is $36 trillion. If inflation runs at 3% annually, the real value of that debt declines by about $1,080 billion per year in purchasing power terms. The government still owes $36 trillion in nominal terms, but that amount buys less stuff, so the burden is lighter. This is a wealth transfer from creditors to debtors. Bondholders and savers get screwed. The government and borrowers see their debt burdens shrink. There's historical precedent for this exact strategy. Post-World War II debt reduction from 1946 to 1970, the debt to GDP ratio fell from 106% to 35%. How? 4 factors. Economic growth, averaging 4% real. Moderate inflation, averaging 2.5%. Financial repression through Regulation Q, which capped interest rates below inflation, forcing savers to accept negative real returns. And fiscal restraint with near-balanced budgets. Economists Reinhardt and Rogoff calculated that 3 to 4% of GDP annually was transferred from savers to government through negative real interest rates during this period. It was a deliberate policy to reduce war debt. It worked, but it required savers to eat the loss. The difference now is we don't have the favorable conditions of the post-war era. We had a baby boom, creating a growing workforce. We had unprecedented productivity growth. We had room to cut government spending after wartime mobilization ended. We had a world desperate to buy American goods. None of those conditions exist today. We have an aging population, slower productivity growth, entrenched spending commitments, and global competition. So the only tool left is inflation. And that's why every policy is designed to stimulate demand without expanding supply. They need prices to rise to erode the real debt burden. Look at the tax policy. The Working Families Tax Cut Act, passed in July 2025, extended individual tax cuts from 2017, enhanced the child tax credit from $2,000 to $2,500 per child, and created new savings account provisions. The 10-year cost is $3.3 trillion. The distributional analysis from the Tax Policy Center shows the bottom 20% of earners get an average benefit of $120 per year. The middle 20% gets $1,470. The top 1% gets $61,000 per year. The top 0.1% gets $244,000 per year on average. But here's the fiscal math that matters. To partially offset these tax cuts, they reduced SNAP benefits by $187 billion over 10 years, tightened Medicaid by $17 billion, and capped discretionary spending by $230 billion. Total spending cuts, $534 billion. Total tax reductions, $3,300 billion. Net deficit increase, $2,766 billion. We just added $2.8 trillion to the debt over 10 years to give tax cuts disproportionately to high earners while cutting food assistance and healthcare for low earners. And the debt service implications compound the problem. Average federal interest rate in 2026 is 3.1%. Annual interest on $36 trillion is $960 billion. Nearly $1 trillion just in interest payments. By 2034, per CBO projections, this reaches $1.4 trillion annually. Interest becomes the third largest federal expenditure after Social Security and Medicare. Let me give you a concrete scenario of what this looks like for a real person. Meet Sarah, age 42, household income $68,000, married, 2 kids. She got about $1,800 in tax relief from the 2025 tax cuts. Sounds good. But her grocery bill increased by about 4% year over year, costing her an extra $900 annually. Her electricity and gas bills increased by 8% combined, another $480. Her property taxes increased by 3% because her home's assessed value jumped, another $720. Her health insurance premium increased by 6% because she's in the individual market and subsidies weren't extended, costing her an extra $1,400. Total increased costs, $3,500. Tax relief, $1,800. Net change, negative $1,700. She's worse off than last year despite getting a tax cut. This is the affordability paradox. Now, you might be asking yourself, what happens when this breaks? Because it will break. Here's the likely sequence. Inflation stays elevated at 3 to 3.5%. The Federal Reserve faces a choice. They can either tolerate above target inflation, which risks unanchoring inflation expectations and causing an acceleration, or they can raise interest rates aggressively to bring inflation down. If they choose to raise rates, here's what happens. Higher rates increase the federal government's interest expense because new debt and refinance debt carries higher rates. This makes the deficit worse. The bond market gets spooked by rising deficits. Yields increase further as investors demand higher compensation for inflation risk and credit risk. The Fed is forced to raise rates even more to prevent a bond market revolt. Higher rates slow economic growth and tip the economy into recession. Recession reduces tax revenue, making the deficit even worse. And we're in a doom loop. This isn't speculation. It's the exact pattern that played out in multiple countries. The UK in 2022 with the Liz Truss budget crisis. Bond markets rejected unfunded tax cuts, yields spiked, and she was forced to resign after 49 days. Italy and Greece during the European debt crisis from 2010 to 2012 experienced soaring borrowing costs and economic contraction. The US has more room to maneuver because the dollar is the global reserve currency and treasury bonds are the bedrock of the global financial system. But that room isn't infinite. At some point, bond market vigilantes force discipline that politicians won't impose on themselves. The historical reference that should terrify everyone is Paul Volcker's 1979 to 82 inflation fight. To break inflation that had become embedded in the economy, Volcker raised the federal funds rate to 20% peak. Unemployment hit 10.8%. The economy experienced 2 recessions within 3 years. It was economically brutal. Businesses failed. Families lost homes. But it was necessary because the alternative was runaway inflation that would have been even more destructive. The question for 2026 is whether we have the political will to accept that kind of pain if it becomes necessary. Based on current policy trajectory, I'm skeptical. Here's the really uncomfortable truth that nobody wants to say out loud. The government needs inflation. Not hyperinflation, but steady 3 to 4% inflation that slowly erodes the real value of the debt while keeping the nominal economy growing fast enough to generate tax revenue. Every policy that claims to help affordability is actually designed to stimulate demand, boost nominal GDP, and create the inflation necessary to manage the debt burden. Lower mortgage rates, 401k withdrawals for down payments, tax cuts, all of it increases purchasing power and bids up prices. This isn't incompetence, it's the strategy. They're trapped. With 36 trillion in debt and no political will to either raise taxes or cut spending, inflation is the only remaining tool. Let me give you 3 takeaways that actually matter for your personal financial strategy. First, position for inflation persistence. The base case for the next 3 to 5 years is inflation running above the Fed's 2% target, probably in the 3 to 3.5% range. This has specific implications. Real assets outperform financial assets. This means real estate with fixed rate mortgages, commodities, and inflation-protected securities become more valuable. Nominal bonds get destroyed. If you're holding long-term treasury bonds yielding 3% and inflation runs at 3.5%, you're losing purchasing power every year. Equities are mixed. Companies with pricing power that can pass costs to customers do fine. Companies in competitive industries with thin margins get squeezed. Second, understand supply constraints dictate price direction, not policy. Housing, energy, and healthcare all have structural supply constraints that can't be solved with demand-side stimulus. This means any policy that gives you more money to buy these things will mostly just make them more expensive. The practical implication is to focus on sectors where supply can expand and avoid lifestyle inflation in constrained sectors. You can't avoid housing, energy, or healthcare entirely, but you can minimize exposure. Smaller house, better insulation, preventative health measures. These are supply-constrained sectors where costs will keep rising faster than your income. Third, the 401k withdrawal for housing is a trap for most people. I know it's tempting. Everyone wants to own a home. But pulling money from retirement accounts in your 30s and 40s to overpay for a house in an inflated market is almost always a bad trade. The opportunity cost is enormous. That money compounds for decades. You're trading 30 years of investment returns for the privilege of paying peak prices in a bubble market. If you can't afford a home without raiding retirement accounts, that's the market telling you that homes are too expensive right now. Listen to that signal. Rent, keep investing in diversified portfolios, and wait for the inevitable correction when interest rates rise or supply finally catches up. The central insight is this. The affordability paradox exists because the government is simultaneously trying to help you afford things and inflate away its debt. These goals are contradictory. You can't give people more money to buy stuff without producing more stuff and expect prices to stay stable. That's not how economics works. Every policy designed to boost your purchasing power in housing, energy, healthcare, or food is actually bidding up prices in those sectors because supply can't respond fast enough. You're not getting richer, you're paying more. The winners are asset owners who bought before the monetary expansion, people who own homes, energy companies, healthcare providers. The losers are savers, wage earners, and anyone trying to enter these markets now. The system is designed this way because the alternative, actually addressing supply constraints through zoning reform, energy infrastructure investment, healthcare provider expansion, requires long-term thinking beyond electoral cycles. Politicians face re-election every 2 to 4 years. Supply-side investments take 5 to 10 years to pay off. So they do what's politically expedient, give people money now, declare victory, and hope the inflation bill comes due after they've left office. This isn't left or right. It's the incentive structure of democratic systems with high debt loads and short time horizons. And you're paying for it every time you buy groceries, fill up your tank, or look at your electricity bill. Lazy investing built more fortune than crypto memes. The people who win are the ones who understand the game being played and position accordingly. Everyone else is getting slowly poached by inflation they don't see coming.